Hey everybody, this is Matt Thomas at tradingparadigm.com, and today I wanted to talk about how you personally view markets. In other words, what framework or methodology are you using to organize and interpret market-generated information? And is that framework robust enough to provide you with a meaningful edge? I often talk about expected value, asymmetric risk-reward, the law of large numbers, acting like the casino, and other critical concepts like this related to trading systems and edge. And while these concepts are incredibly important to understand, they don't really explain market dynamics and structure. Like, what actually moves markets? Why does price move from one area to the next? How do you know when an optimal opportunity presents itself? Where does your edge actually come from? I think it's really important to cover this topic because most traders, at least when they first start out, take a one-dimensional surface level approach. They tend to get lost and confused in the chaos of price movement and completely ignore what's going on under the hood, so to speak. There's a mixture of bad education and training, along with a desire to find easy answers to trading success. And as a result, beginners think that simple price patterns, like double tops and bottoms for example, are their golden ticket. They're told that these patterns work and that they can generate thousands of dollars per week following them. But there tends to be very little, if any, regard to context. The reality is that following any random pattern will work some of the time by mere chance. But this doesn't usually equate to an approach that produces a sustainable form of positive expected value. Most likely, what traders are missing in this scenario is a robust form of contextual analysis, an effective methodology for viewing and analyzing markets that allows you to make higher probability decisions based on liquidity levels, areas of low and high volume, time the market is spending in certain zones, and overall order flow. Anybody can draw some horizontal lines on a chart and call them support and resistance levels. But they're only potential support and resistance levels until the market goes back to test them. And when this happens, how is the market treating those levels in real time on the hard right edge? How did price move into the level? Quickly or slowly? What's the tempo? Are buyers being more aggressive than sellers, buying the offer? Or are sellers being more aggressive than buyers, hitting the bid? Is absorption taking place, or unusually high volume at a specific price level without the market being able to push beyond, which might signal the existence of a large player? These are all nuances of contextual analysis that many new and struggling traders simply don't understand. But the reality is that not all instances of a certain price pattern are created equal. There's much more to it than the shape of a price chart. So as an active short-term trader, you need a more potent framework. You have to be able to discern the strength or weakness of a level in real time. The best way, in my opinion, to expand upon the typical one-dimensional and overall inadequate view on markets that struggling traders tend to have is through the understanding and application of auction market theory and the volume and market profiling tools often associated with it. Auction market theory is the philosophy that financial markets are auction mechanisms that exist to facilitate trade. Price advertises opportunity, time regulates opportunity, and volume shows strength or weakness of participation. The overall goal of the market is to discover prices where buyers and sellers are willing to do business. Prices where buyers and sellers spend the most time and do the most volume are areas where they're agreeing on value. This characterizes a balanced market. On the other hand, prices where buyers and sellers spend little time and take part in a low amount of transactions are areas of disagreement, and this characterizes imbalance. Inside this framework of auction theory, price movement isn't just some random and chaotic phenomenon. Markets move from areas of balance to imbalance, back to balance, and then imbalance again, over and over. And these areas of past, current, and developing balance become key reference zones for future price movement. And based on these key reference zones, strategies and risk processes can be built around them. Where market profile, volume profile, and other volume analytics tools like volume weighted average price or VWAP, cumulative delta, and footprint charts come into play is that they record and display the critical market generated information of time, price, and volume in unique visual ways that are far more powerful than basic line, bar, or candlestick charts on their own. To wrap things up, successful traders have a level of personal and market understanding that the masses simply don't have. And this in-depth emotional and behavioral understanding is the foundation for developing strategies and systems with edge. Just to be clear, auction theory by itself is not a strategy. It's a framework for explaining market activity. And market profile, volume profile, VWAP, cumulative delta, and footprint charts aren't strategies either. They're simply tools for effectively organizing critical market-generated information. But what a framework and supporting tools like these does is provide structure around market behavior and reveal patterns to you that aren't visible to the average oblivious trader. With a solid grasp on market dynamics and structure, you can then develop individual setups, strategies, and systems based on the specific markets, instruments, and timeframes that you trade, as well as your own personal schedule, account size, risk tolerance, cognitive strengths, and overall circumstances and preferences. This means that you can build systems that actually fit you, like a real trader, instead of blindly copying alerts, signals, and cookie-cutter technical setups. There is no one-size-fits-all approach with simple price patterns and fixed stop losses and profit targets, like many people in the industry want you to believe. Extracting edge is far more nuanced than that. So I suggest ditching any of your ineffective beliefs on how markets work and learning to view them from the perspective of price versus value. Looking at markets through the lens of auction theory and the profiling tools often used in conjunction with it isn't the only way to observe and interpret the markets, but it's what makes the most sense to me. It's removed so much of the confusion and mysticism surrounding market activity, and you might be shocked by the consistency of market behavior when viewed through the auction process. I'm not trying to force you down any specific path in terms of your trading methodology, because that's ultimately up to you, but not making you aware of all this I think would be a huge mistake on my part. This is something that I believe can help traders of all kinds. You can find the link to this full article down in the description, and I'll talk to you in the next video. Take care.